Welcome back to Wealth Mavericks, the podcast where we help doctors unlock the secrets to building generational wealth. And today we're talking about the risk that comes with investing and how to weigh potential risk versus potential reward.
Everybody's situation's unique, which is why we have to go through this process of developing a asset strategy using your existing assets, making sure they're in the right position, the right structure, and what assets do we need to add to that to create that outcome of lower taxes or a certain type of accumulation of wealth.
No single plan is going to mitigate all of the risk that you have. There's always going to be some hole in that strategy or in that layer of defense. And so the idea is how do we mitigate that by adding more layers to that?
Hey guys, so we're going to keep talking about investments and the risk that comes with it. This comes up as a question with many of our members as we're presenting the plan and the different investments. Well, how likely am I to lose my money? What is the risk involved? And of course, there's always risk with investing, but there's a continuum here. So I'd love to dive a bit deeper into various investments and how risky they are.
Mm-hmm.
So before we go into it, I know I'd love to hear Joe has a couple analogies to help us understand kind of the focus and how to maintain risk. But I want to just make sure people know that we're not giving investment advice here. We're not. This is just educational purposes only. We're just focused. We're using the word investment just because that's a terminology that you're used to. The reality is that we're talking about assets, building assets, using assets as assets, not as investments. There is a clear distinction and difference of what we mean when we talk about that. But we're just going to use that term investments just so it's a common knowledge, common language for you, Doc, to understand. But if we interchange that, I know I will probably say assets probably more times than investments. Just know that that's what we're talking about, that correlation.
All right.
Yeah, I think, one of the things that comes up in the world of financial advice and building wealth is going to be investments. I don't think that you can't build wealth without having investments or assets that are doing something for you. And traditional financial advisors will have you fill out what's called a risk assessment form. They're basically asking you, how comfortable are you with losing money? And what I've found is people are very comfortable losing money until they lose money. And then you find out what their actual risk tolerance was.
Totally.
It's oh no, totally. I was not very risk tolerant.
Yeah.
And a lot of the planning that we do is predicated around the goals that somebody has. So for example, we have a lot of doctors who feel like they want to practice probably for the rest of their life. They don't have a desire to stop practicing, but hitting that moment where work becomes optional, what people might call retirement, is usually in their horizon or in their goals. And depending on how far that is and what your current level of assets is, might require higher risk in order to obtain higher reward. Bob, I know I'll have a lot to say about that. It doesn't always correlate. The higher the risk, the higher the reward. But the analogy I wanted to use is something that I've learned. I'm a skydiver, and in skydiving, there's, I would say, a very high reward. You're flying through the freaking air. It's awesome.
No, you're not. You're not flying. You're falling.
You're falling. That's right. You can fly your body though, and then when you get under canopy, then you are flying. But that is, it is also a high risk scenario. The ramifications of messing up on that are really high. So in skydiving, they talk about risk mitigation in a similar way that we talk about in investments. And they use what they call the Swiss cheese analogy. Imagine if you had one piece of Swiss cheese with holes all over it. You wouldn't want that to be your defense, like if risk is going through there. But the idea is, Swiss cheese, if you've got a hole in the piece of Swiss cheese, you want to put something else behind it. No single plan is going to mitigate all of the risk that you have. There's always going to be some hole in that strategy or in that layer of defense. And so the idea is how do we mitigate that by adding more layers to that? So in skydiving, you do a lot of checking of your equipment. You're checking other people's equipments. There's rules, well, not rules per se, but there are things that you want to follow in order to ensure your safety to have the highest outcome of landing back on the ground safely. So with that being said, I think a lot of the work that we do at Terra Firma in helping our members is to mitigate that risk through different strategies, different layers to that defense.
I like it. That's very helpful to picture Swiss cheese in a package. Like, you can't see through the holes if you have a bunch of them, but if you just have one, okay, makes sense.
Yeah. And I think a lot of times we need to understand that some of the terminology that Joe brought up with regards to risk reward, risk tolerance, these are really structures that are really designed for the retail investment. So in previous episode, we had talked about the difference between an accredited and non-accredited investor. But the retail investment world is where most financial advisors come into, where you have your stocks, bonds, mutual funds, your retirement accounts, and right, that's all in there. You're working with Fidelity, or your money's in Schwab, or whatever the case may be. Those are all retailers. Okay. And so we have certain things in there talking about allocation, diversification, risk tolerance, right? And understanding the different types of risks associated. So we have risk designation of a particular, is it aggressive? Is it moderate? Is it conservative? And in each of those sections has a different type of an stock, bond, mutual fund, or whatever the case may be in there. You have a 60-40 split, 60% in stocks, 40% in bonds, right? So you have all these correlations, and these are things and structures, rules, guidelines, if you will, bumpers in a bowling lane to help the professional financial world to communicate to the non-professional investor world, right? You. And so also a lot of these are safeguards to protect the advisor from you. Because to Joe's point earlier, what's your risk tolerance? Oh, I'm okay with losing 30% until you lose 30%. And it's very easy for an advisor to say, we went through this and you signed it. Right? Does that make you feel better? Oh, okay. Oh, okay. 30% loss. All right, we're okay now.
Now I'm okay.
Yeah. Phew, thank you for reminding me. Right? No, I still lost 30%, right? So, in risk doesn't necessarily correlate with reward, right? It depends on where you're going to move your money, what kind of assets you're using. One of the things they don't talk about is the longevity or the lack of liquidation or liquidity in a particular type of investment. Right? So if your money is tied up in some place for a longer period of time, typically that type of investment, that asset may actually have lower risk because there's less liquidity that's required by that investment or that asset to create liquidation events for investors. Right. And so there's a risk there. We don't talk about it a lot of times because a lot of times you're looking at it from a retail investor perspective with your financial advisor. Right. And so that they're charging you a fee based on your assets, and you're like, oh, okay, well, you're a financial advisor, right? So, but here's what I find interesting. In my world of financial advising, money, insurance, taxes, bookkeeping, and business consulting, a lot of those service-based businesses, those professionals don't only just work with you, a physician. They work with whoever says yes. And then after their long period of their longevity of the career, they don't make a designation based on what you do in a profession. They make a designation based on the money they're managing or the type of policies or the success of a business or whatever the case may be, not necessarily who you are. Right. So that's a huge difference. It's very important for you to work with people who are helping you build your wealth and reduce your tax liability and understand all these aspects that they all intertwine. They all intertwine. So it's important for you to have people that understand you as a physician, the uniqueness of you as a servant to the community, and what your overall guidelines and rules and your scientific mind of wanting to know certain things, right? There's aspects that there's a relationship, a give and take relationship that goes back and forth with that. And so that's important when we're talking about these types of risks. It's understanding that. It builds knowledge, it builds confidence, it builds understanding. To Aaron's point, There's risk in everything. There's risk in sitting on cash, right? So,
well, and I think, and it is important that people understand those investments. There are some investments where you have 100% risk, meaning you could lose everything. There are some investments where you could lose more than everything that you've invested, unlimited, risk. So I think it is important that you as an investor, you as an asset builder, or asset gatherer, you've got to understand the risk that exists in there. When I go skydiving, I feel differently on a day when I'm going to go skydiving, when I know what's going to happen, the risk that exists there. I'm heightened attention to what I'm doing. All of that is important. It's important to understand. I don't step into an airplane that I'm going to jump out of the same way that I just step into my car to drive to the grocery store, right? There's a different level of preparation. The potential for risk needs to be understood. So we're not saying that you shouldn't be paying attention to it, but you just should know what that means. And just because there's big risk does not mean that there's big reward.
That's right.
So we said in the beginning, weighing risk versus potential reward. And I know on meetings with members, I'm listening to Bob talk and I hear him say, well, we talk about preferred returns and like the risk being very low because they're boring investments. So can we give some framework of like, what can someone take themselves through to assess their own risk tolerance? Or if they're assessing which investments to go into, kind of top line view of like, what are those boring investments that are going to, have lower risk versus the most risky things? How much can you say on that?
I think first and foremost, somebody's understanding of risk is based on their previous experience with what that area has taught them. What I mean by that is if we're talking to a doctor who's been burnt by people in the past, to Joe's point, they're going to be a little more heightened, right? When, like Joe said, when he's going to go skydiving, he's on full alert, right? He's looking at everything, right? He makes sure his fingernails are clipped the right way, right? I mean, everything is ideal and perfect to make sure the outcome is ideal and perfect and successful to what you want as the outcome. The experience of you as a member, that's the first and foremost. So a lot of times when we meet people that are come to us, they share their experiences with previous situations and relationships. So our first thing is to be able to not even talk about all that stuff. It's more talking about them and build that comfort and that understanding. Because if they come to the party, so to speak, come to the table, the relationship with all these fears and all these past scar tissue and experiences, it's going to affect their mental outcome of what's going to happen. They're going to make decisions that are not necessarily a normal decision they would make without that type of emotional, those experiences. So that's really the first thing. And it's not that we expect our members to trust us right off the bat. We expect them to ask questions. You guys know, you've seen me on calls. I over explain things. And I do that purposely because of a transparency that you deserve the right to know. You may not remember everything. That's okay. You're going to remember something. Something's going to trigger a question. We want that dialogue. Okay. So I think that's first and foremost. Now, once we bypass that and we get through that, then it's understanding, what is my outcome that I want? What is my end in mind? That's what first and foremost, not my rate of return, right? Well, not how you're going to diversify my portfolio. It's my outcome. How predictable can we make my outcome? Right. And it can't be to the T guaranteed outcome, right? That does not exist, so to speak, to where we're allowed to say that word guarantee. That's not a word that's in the vocabulary of what we do. Right. But you can get as close to predictability based on understanding the type of assets you're going into. Right. And so it's no different than working with any of our doctors. And if they own their own practice, we can say, hey, so what was your revenue like in profitability the last 3 years? We go through that. They tell us, what do you anticipate this year? Guess what? It's going to be very similar. Predictability. Why can't we do that same predictability with other assets? We can. That's what the historical returns are supposed to do. That's what understanding that particular asset is supposed to do. So once you understand what the outcome is and how you can come close to predicting the outcome and what that looks like, such as how long do I have to hold this investment? Oh, well, in this particular one, it's about a 5-year hold. Our goal as in this fund is to have a liquidation event in 5 years, meaning that we sell this, for example, real estate. We sell this property. We've held it for 5 years. We sell it in 5 years. If we get a great offer on it before that, we may be put in a position that we have to do that for our investors. Or it's in a particular area where it's like, it's a good market, but there's not a lot of biting to sell it at 5. We'll hold it to 6. We'll hold it to 7 and liquidate at 7, right? But the outcome is always looking at 5. Obviously, there are variables, right? And so we know going into it. And based on that, over years and years of doing this, working with experienced people, they know what type of asset they're going to get to have that predictability. That's part of managing risk. Then you reverse engineer, you add another asset. And what's that do? Do you have 2 assets? One has a 5-year, one has a 3-year. What kind of return can I get? Do they have preferred returns? You brought up preferred return. This is our terminology of saying that this is what you're going to get as a return minimum. It's the preferred return. You may get more based on how the asset performs, but this is our predictability of what our preferred is. And it's written in the documentation that is submitted to the Securities Exchange Commission. Okay, again, it's not a guaranteed return. We can't use that word. We call it preferred. Okay, and sometimes you have preferred returns based on the amount of money somebody invests. The more you invest, then we can probably offer a higher preferred because you put more money in and allows us to do more with that money with that hold period. Right? So the type of asset and the outcome lowers the type of risk. Okay? Doesn't eliminate it, but lowers it. So you can become a little more predictable. Then that allows you to say, oh, I have some extra funds that I want to invest in another type of asset. What's that look like? Great. Let's go look at that. Right? And so, Warren Buffett said it, and I'm paraphrasing, but he said basically diversification is the word for the uneducated, what they're doing with their money. Warren Buffett is not diversified. In his stock portfolio of earning dividends and the various companies, he is not diversified. He is very specific, but he makes $1 billion a year in dividends off the whole stock holdings he has. Now, when you look at his list of companies that Berkshire Hathaway owns, you can make the argument there's diversification. But when you look at it, he's not diversified in multiple industries. There's a handful of industries that he buys multiple companies because those are predictable to be very good managed financially and human managed to where it makes sense for him to deploy capital into that. And then you rinse and repeat. He's done it for 60 years. It's not a surprise, right? So I think that's really what's important when you're looking at assets is kind of looking at it from that perspective. And your situation, Doc's different than everybody. How much liquidity do you have? Do we have an emergency fund? Your expenses, do they meet your income? Or is there a good marginal gap between what you spend in a livelihood and what you earn in a livelihood? Is it W-2? Is it profit from a business? Do you have other investments? What are those looking like? Right? Everybody's situation's unique, which is why we have to go through this process of developing a asset strategy using your existing assets, making sure they're in the right position, the right structure, and what assets do we need to add to that to create that outcome of lower taxes or a certain type of accumulation of wealth.
Well,
right?
I think that's the problem is that most people with this hodgepodge of advisors that they have multiple pieces of Swiss cheese, but they're not lined up. It's like this person is talking over here, this one's over here. It's like you have not created layers of protection. You need to speak with someone who is holistically looking at what are your goals, where do you want to go, and what are the strategies that we put in place in order to get you there and protect you from the risk that can happen. Just because there's a hole in the Swiss cheese does not mean that thing is going to happen. It just means that there is a risk that's there. What's the likelihood of that risk being, piercing that? So stop doing that. Stop having all these pieces of Swiss cheese all over the place. Get them aligned so that you can actually accomplish what you want to accomplish with the least amount of risk possible.
That's great. Thank you. And
skydiving and Swiss cheese. And
I love it. It's a great visual. And if you're listening and you think, yeah, I want to be investing in these different things, but I don't want to spend the mental energy so much on vetting them all and assessing the risk. And like, that is what we do for our members. We have spent Bob has spent years and so much time and energy putting together this all-inclusive one-stop shop that will put together that plan and make sure that you're mitigating the risk. And I love what you said too, Bob, about how oftentimes when it comes to investing, like the sole focus or the first focus is lowering taxes, because that's the immediate pain that people have, is like, I'm sending so much to the government every year. But when you're structuring your assets correctly and growing your wealth, the tax savings is a byproduct. So let's start there and let's align it to your goals, put together a plan, and you just have that peace of mind then, knowing that you have a team that's looking out for it all for you. So if that sounds like something you'd like in your life, find us online at our website, on social, book that first meeting. It's a cash flow recovery. We can tell you pretty quickly how much you're overpaying in taxes, what you could be saving and putting towards your wealth instead, and then we can go from there. So thank you so much for listening. We hope you'll join us again. And until then, go be a Wealth Maverick.